Welcome to Blackheath Revisited. This is a follow-up case to the very first case that you had in the class where you had a single product line, and if you remember, you were evaluating whether or not the company had set up the right policies or decision rules for accepting special orders. And what we had found when we looked at that case is that they had rejected three orders that they should have accepted because they had a flawed decision rule. And the reason why the decision rule was flawed was because it included fixed costs. And so in that case, you were meant to learn that in this situation where you have excess capacity, you're not fully utilizing all of your resources, you should accept any order that generates a positive contribution margin. So that allows you to really just kind of ignore the fixed costs, because fixed costs are not relevant to the decision. They're fixed. They don't change regardless of whether you add a special order or not. So that's kind of the assumption when we say a fixed cost is fixed, that it doesn't change with changes in volume, at least in the short term. Okay, so we assume we've got some wiggle room here. So in this case, if you remember Lehigh, he actually gets let go in this case, and they hire back Adelaide Ladywell, the person who had gotten fired in the first case. And they talk about some of the problems the company is having, and the son takes over for the father and is very concerned about their ability to make money, make a profit. So he hires someone that he knows who's a specialist, a consultant, in creating budgeting processes and evaluating companies' planning process. Because the budget is part of a company's planning process. So we're planning what sales are going to be. We're planning what our costs are going to be. We're planning what our profits are going to be and how the balance sheet is going to kick out. And so one of the first things we do in the planning process every year is to create a budget. So you're going to be creating a budget for the first quarter of the next year, and you're given a bunch of similar assumptions to what you had previously, so hopefully it looks very familiar to you. Your variable manufacturing costs are still $2.80. Hopefully that rings a bell. Your fixed costs are still $710 for manufacturing, plus an additional $781 for selling administrative costs, and those were per week. All right, so that hasn't changed. You're given some additional information on the accounts receivable collection pattern, which is going to be interesting for you to work through. So when a customer buys from this company, on average, we get a certain percentage of that money the month of the sale, the month following the sale, the second month following the sale, and the third month following the sale. And if you notice at the bottom of page 104, it assumes that we collect 100% of what our customers have been billed. So essentially what we're saying is we're not going to allow for bad debts, so allow for uncollected accounts. It just keeps things simple. I don't want to get too deep into the gap. We'll let the accountants handle that stuff. What I want you to do is put together a basic plan for this company, and that's a big enough job. All right, so you've got, in part 2 on page 104, you got lots of stuff that should look familiar to you. And then on page 5, also a lot of stuff there that should be very familiar to you, as well as some new information. For instance, the amount of the draw for the owner and the amount of the fee for the consultant. You're also given information on the type of depreciation that they're going to use, so that's a straight line method. You're given residual values, so you've got to remember how to do that. Those formulas are built into the template, so you'll be able to walk through that stuff. Initially, I want to talk a little bit about the difference between absorption costing and variable costing. So if you remember back when we did the Blackheath case, I had you do break-even prices. And part of the reason for doing that was for you to get your mind wrapped around full cost. So when I say absorption costing, what I'm talking about there is the accounting for full cost. That would include both the variable cost per unit and the fixed cost per unit. And you recognize, hopefully already, what the challenges are with dealing with fixed cost per unit. So in order to get cost of goods sold, you do need to use absorption costing or full costing. So there's a reason for us wanting to do that. However, if you notice towards the end of the case, very last page, part 8, I'm asking you to re-evaluate using variable costing. So variable costing is not GAAP compliance. This would be more of an internal process. And the reason why companies like using variable costing is for the exact same reason that we liked using contribution margin as the decision-making criteria for a special order. So if we can just look at what's going on at that level where we factor out the variable costs, it gives us a better idea how much each product line or even each division or each region is contributing to covering the fixed costs. So eventually, I'm sure for a lot of you that are currently working, you have more than one product line. So again, we're looking at a super simple example and you see how complex it is already. But most companies have multiple product lines and they got to figure out how to allocate these costs across multiple areas. So if you start with variable costing, then that at least allows you to track the direct cost to each one of those various pools that you're looking to assess. And then you can figure out how you want to allocate fixed costs. So generally what we would say is, well, let's break it down into those fixed costs that can reasonably be traced to the various areas and with accuracy. And then we have some other costs that perhaps are indirect, which may be at the headquarter level and are very difficult to apply to the various product lines or divisions, whatever you're looking to assess. So we break it down and we take it in baby steps in a sense. So variable costs, then traceable fixed costs, then untraceable costs. All right, so let's go ahead and go to the next slide. There we go. These are the learning objectives I have for you for this time around. So something called master budget. So master budget includes all of the budgets starting with sales. So whenever you're creating a budget for any organization, you always start with the amount of revenue that you expect to bring in. So you start there and then you work out your costs, and then one of the last things you do is back up into the balance sheet to figure out what you should have for ending balances and all the various accounts to make this whole thing fly. So that's what you're going to be doing here, is developing a full-out master budget. And then you also are going to be comparing the January budget to January actuals to assess how they did. So how did things go relative to budget? You'll do a break-even point to help you assess where you're going to be at a given point in time, and given the cost structures that you have, what level of volume does it take before you start to break even? And then you're going to compare variable and absorption costing methods. I already talked to you briefly about that. All right, so as I mentioned, the owner's son is coming in to run the company, and he asks his consultant friend to examine the company to see what's wrong. And Broccoli concludes that Lehigh's guidance guidelines are all wrong, and you knew that from your first case. And he believes they need to develop a better budgeting system and to reverse the declining profitability. He also suggests that Adelaide be rehired. So we're going to construct several budgets. We're going to construct a variance analysis. We're going to construct financial statements. We're going to do the variable versus absorption costing. And then I also ask you to do a dashboard at the end with some key performance metrics. All right, so as I briefly mentioned before, we always start with our revenue projections. So you see that in the first bullet here, where we start with the revenue projections. And you're going to notice, of course, you should expect this, that we set our budget for revenue. We then have to build out our production budget to make sure we create enough units to fill the needs of the budget, right? Fulfill the revenue projections. And you're given projected sales goals, so units and price, for December through April of the upcoming year. Those are in the template and also in the book. So given that sales figure, you are then required to build the first quarter production budget to ensure that the firm can meet those revenue targets. And then from there, once you know what your production requirements are, you then build your raw materials budget. So estimate how much you need to acquire in raw materials. From that budget, you will also obtain your month-end balance sheet figures for the inventory numbers. So you can see that all the way down through, everything's interconnected. In a sense, it tells a story of what's going to be going on or what we expect to be going on within the business. It will drive all the decisions that we make in terms of procuring our resources, hiring people, and being able to meet the needs of our customers. So the demand of our customers. All right, so that's the first tab. On the second tab, you're going to analyze the manufacturing costs and sort out the variable and fixed components. That will allow you to compute the cost of goods sold and construct elements of the income statement. And that's on tab 3. In the income statement, you're going to include the manufacturing costs, which you'll capture in cost of goods sold, as well as the SG&A costs, to then derive the net profit or net income for the first quarter. On the fourth tab, you're going to build a cash budget. This is usually one of the most challenging aspects of building a budget. You got to consider that collection pattern I talked about earlier for accounts receivable, and also the payment pattern for accounts payable. So once you get past all of that, then the other expenses assume a more regular pattern, and it's a little bit easier. So get past the AR and the AP, and then it gets a little bit easier. On the fifth tab, you're going to do the balance sheet at the end of the quarter. All right, so just a heads up, your balance sheet on April 1st is also the balance sheet for March 31st. So you end the month at some point, you open the next month at the same point. On the 6th tab, you get to the break-even point calculation. On the 7th tab is where you do that budget versus actual comparison. On the 8th tab is where you get to the variable versus absorption costing. And finally, on the 9th tab, you're going to be doing a dashboard. And although I find more and more students are becoming familiar with what a dashboard is, I always find there's still students who've never heard of the term, and this might be the first time they've ever created anything like a dashboard. So dashboard is kind of like what you might think about in a car, where you've got certain indicators. You've got your speed, your RPMs, you've got your gas level, and other indicators that are there in front of you to help you know how you're running the car and how the car is running. Right? So how fast you're going, how much fuel you got left, all those kind of things. So it's the same idea with a business. So perhaps, one of the dashboards would be what you expect sales to look like over the next 3 months, so the first quarter of the year, or what your composition of expenses are. So if you did a stacked bar chart or column chart, where you showed the composition of the costs that were incurred, or the profitability trend over the 3 months. So just use your imagination. It's one of the areas that I kind of left wide open, and I didn't make absolute suggestions. I like to see the creativity that comes out of the class, and I like to see what you think is important, because it helps me to get better information about your business acumen. So if I think that you're picking some of what I would call the critical elements of information that a company would want to have at their fingertips on the dashboard for helping them manage the business on a daily basis. So let me say that too. For many companies, they use dashboards, and those dashboards are connected to their real-time data. So they're updated constantly, real-time. So they have a constant feel for what sales are. They can even do it over regions. So if they have multiple regions where they're located, they can have dashboards that are showing them budget versus actual sales over a particular region. And it can also indicate a red flag, something's wrong, send an alarm, so to speak. Okay, so try that, give that a shot. So as I said, make sure you allocate enough time for this one. It's a fairly long case. I look forward to working with you on